source for sharp, focused market insights. It's Tuesday, September 16th, 2025, and we're digging into the financial intelligence brief for yesterday, Monday, September 15th. If Monday felt like navigating a complex spreadsheet, today we're simplifying those data points into actionable insights for you. So our mission today, basically to unravel two primary drivers that really shaped yesterday's markets.
Right.
First, those record tech-led gains across U.S. equities. And second, some welcome signs of easing U.S.-China tensions that, sent ripples globally.
Definitely key points.
We'll explore how these powerful currents influence everything from commodities and crypto to real estate, and crucially, what catalysts are looming on the horizon for the rest of this week. And just a quick note, this deep dive is powered by NextSight. They're a global intelligence and investigations firm.
They do great work.
They really do. They turn raw signals into actionable strategy. They've got this open source intelligence platform, OSINT, called Site Connect, helps clients tailor reports to precise priorities. You can learn more at www.next-sight.com. Okay, let's unpack yesterday's action, starting with U.S. equities.
Let's do it.
It really felt like a day where the tech sector just couldn't be stopped. What really drove that momentum?
You're absolutely right. U.S. markets, particularly the tech-heavy segments, showed exceptional strength. The S&P 500 closed at a new record high. That was 6,615.28, up 0.47%.
Okay, solid gain.
But the NASDAQ composite, that really led the charge, climbed 0.94% to 22,348.75, also setting a fresh all-time peak.
Wow.
And this wasn't just, broad-based optimism. It felt pretty pinpointed.
So specific titans were at play here, not just a rising tide lifting all boats. Who are the major contributors pushing those records?
Indeed. Yeah, we saw some truly significant moves from individual companies. Tesla, for instance, surged 3.6%.
After the Musk buy.
Exactly. After Elon Musk made that substantial US $1 billion stock purchase, this wasn't just a CEO buying shares. It felt like a strong vote of confidence, clearly resonated with investors.
Sure did.
Then there's Alphabet, gained a remarkable 4.5%. That pushed its market cap above the US $3 trillion mark.
$3 trillion. That's just
huge. It's a historic milestone, right? Underscores the sheer scale and, dominance of these tech giants. Even Intel climbed 2.9% after divesting a stake in its Altera unit. So that shows that strategic restructuring can also fuel investor enthusiasm.
right. Another way to boost value. Beyond these individual power plays, was there a broader psychological current driving this bullishness? Like, were investors making bets on the Fed's next move?
Oh, absolutely. That's a crucial connection. The underlying sentiment was deeply tied to expectations around the Federal Reserve. Investors were confidently pricing in like a roughly 96% probability of a 25 basis point rate cut.
96%. Pretty much baked in then.
Right. At the FOMC meeting, which actually kicks off today, this near certainty in the market's mind fueled a sort of risk-on environment. It allowed investors to embrace growth stocks, maybe disregard some of the lingering inflation concerns we've seen. It really suggests the market believes the Fed's hand is kind of forced towards easing.
That strong conviction about a Fed rate cut certainly seems like a powerful force. But, while U.S. markets soared, the global picture is often far more complex. How did Europe and Asia fare, especially with those signs of easing U.S.-China tensions you mentioned?
You're right to point out the nuance. Yeah, the picture across the Atlantic and Pacific was indeed varied, though I'd say generally positive. In Europe, the pan-European STOXX 600 gained 0.42%, hit a 3-week high.
Okay.
We saw luxury houses like LVMH and Kering rally on positive analyst coverage. That indicates pretty strong consumer demand for high-end goods.
Makes sense.
But what's truly fascinating here is how France's CAC 40 actually jumped 0.9%.
With the Fitch downgrade.
Exactly. Despite Fitch lowering France's credit outlook to negative, this tells us that, in the current climate, broader market optimism may be fueled by those rate cut expectations.
Yeah.
It can sometimes override sovereign rating concerns, at least in the short term. Investors are seemingly looking beyond the immediate headlines.
That's quite a powerful signal of resilience then. And in Asia-Pacific, did we see a similar pattern, or were there different dynamics at play over there?
Asia-Pacific markets also saw significant movements, largely buoyed by those same expectations of a U.S. rate cut and, like you said, the welcome news of easing U.S.-China tensions. The MSCI Asia ex-Japan index climbed to a 4-year high.
4 years, wow.
And Japan's Nikkei 225 edged higher, reaching fresh, unprecedented levels at 44,904.13.
Just keeps going.
But it wasn't a uniform rally across the region, which offers an important insight, I think.
Okay, what were those divergences telling us? Where did things look maybe a bit different?
Well, mainland Chinese stocks, like the Shanghai Composite, they actually slipped 0.38%.
Oh,
And Indian equities, specifically the Sensex 30, also dipped 0.15%.
interesting. Why the difference?
This divergence is crucial. In China, you've got persistent caution around the property sector. It continues to be a systemic vulnerability acting as a drag.
Still that overhang.
Right. In India, we saw some selective sell-offs in IT and financials, suggests investors are getting maybe a bit pickier even in high-growth markets. Conversely, Korean shares, the KOSPI, rallied strong, 1.11%, as chip makers gained.
To momentum.
Yeah, and Taiwanese semiconductors continued to lift the Taiwan-weighted index, up 0.99%. So this highlights how sector-specific strength, particularly in tech manufacturing, can really drive regional performance, even when other large economies are facing headwinds.
Right. Okay, beyond equities, the commodity markets yesterday tell a particularly compelling story, especially in energy and precious metals. What were the driving forces behind that surge?
The commodity market was definitely a focal point. Oil prices saw a pretty significant surge. Brent crude settled up 0.67% at U.S. $67.44 per barrel. And WTI crude gained 0.97% to U.S. $63.30 per barrel.
What pushed them up?
The primary drivers were a mix of geopolitical tension and fundamental supply-demand dynamics. You had those Ukrainian drone attacks hitting Russian refineries.
Right, supply risk.
Exactly, introduces immediate supply risk. Additionally, former President Trump urging NATO allies to halt Russian oil purchases adds political pressure that could tighten global supplies. All of this, coupled with tightening heavy oil supplies and resilient diesel demand, industrial activity keeping consumption high, certainly pushed prices up.
And refined products, too.
Yep. U.S. gasoline futures, RBOB, rose 1.16%, and heating oil, ULSD, climbed 1.38%, so it was filtering down.
So geopolitical events and strong demand putting upward pressure on energy.
Right.
What about gold, often seen as a safe haven, particularly during uncertain times?
Gold had an absolutely extraordinary day, hit an all-time peak.
Really?
Yeah, surged 1.1% to U.S. $3,680.80 per ounce. This isn't just a number, it's a significant indicator of market sentiment, I think.
So what drove that record?
Fundamentally, it was driven by a softening dollar and falling treasury yields.
Okay, explain that a bit.
Well, when the dollar weakens, gold becomes cheaper for holders of other currencies, so that increases demand.
Right.
And when bond yields fall, the opportunity cost of holding non-yield-bearing assets like gold decreases, makes it more attractive. This dynamic was strongly reinforced by that high probability of a Fed rate cut we talked about earlier.
Tying it back.
Exactly. Suggests investors are hedging against potential inflation or maybe currency devaluation down the line, even as they price in an easing Fed. Futures even closed slightly higher at U.S. 3,719 ounces. Reflects that bullish sentiment.
A new record for gold that's definitely a headline in itself.
Yeah.
Reflects those complex undercurrents. And copper, often seen as an industrial bellwether. How did it perform?
Copper actually retreated a bit yesterday, down 0.75% to U.S. $4.62 per pound. Pulled back from its 6-week highs earlier in the month.
Okay, I'll pull back there.
However, it's important to understand the broader context here. You've still got ongoing supply disruptions at major mines in Indonesia and Chile.
Right, supply constraints.
And those continue to underpin prices. So even with this slight pullback, the fundamental story for copper, given its essential role in, electrification and green tech, remains one of constrained supply meeting future demand. That tends to provide a floor under its price.
Fascinating movements across commodities. Shows how global events intertwine with industrial demand and investor psychology. Let's shift gears now. Fixed income, foreign exchange, and the incredibly dynamic world of cryptocurrencies.
Okay. Starting with fixed income, U.S. Treasury yields actually drifted a bit higher, which might seem counterintuitive given the strong expectations for a Fed rate cut.
Yeah, you'd think they'd go down.
Right. The 10-year yield rose to 4.06% and the 2-year to 3.56%. This modest sell-off was likely as investors adjusted positions ahead of the FOMC meeting, maybe taking some profits or anticipating slightly higher inflation if the Fed does cut. Exactly. In contrast, Germany's 10-year bond yield eased to 2.70%, and the UK's 10-year gilt yield slipped to 4.64%. Those markets also anticipating rate decisions from the Fed and the Bank of England suggest maybe a more dovish outlook for European central banks, perhaps. Japan's 10-year JGB yield held steady at 1.60%.
And credit spreads, often a good indicator of underlying market health and risk appetite.
They remained remarkably tight, which is a key insight into the current credit environment. Both the ICE BOFA investment-grade credit spread, hovering around 77 basis points,
Pretty low.
and the high-yield spread, near 279 basis points. They signal what we call a benign credit environment.
And for listeners, what does that mean exactly?
Well, a credit spread is basically the extra yield investors demand to hold corporate bonds over risk-free government bonds. So when these spreads are tight, it means investors are perceiving corporate borrowers as less risky. Or they're simply more willing to take on risk in search of yield.
Okay.
This reflects continued strong risk appetite among investors, even amidst these broader macro uncertainties.
What about foreign exchange? How did the dollar react to all these converging factors?
The WSJ dollar index slipped 0.24% to 94.62. This softening was largely a direct consequence of investors rotating out of the safety of the dollar into risk assets
Chasing yield elsewhere.
and trimming their long dollar positions in anticipation of the Fed meeting and that potential rate cut. They're betting on a weaker dollar post-cut. The euro traded near US 1.17666 and the yen around 147.3 per dollar.
Any moves from China's central bank?
Yeah, an interesting move came from the People's Bank of China, the PBOC. They set the USD-CNY midpoint at 7.1056, stronger than expected.
Signaling something.
It's a pretty clear signal from the PBOC of their willingness to curb yuan depreciation, try and maintain stability in their currency, likely to manage capital outflows and investor confidence.
And then the digital frontier cryptocurrencies. Always a lively space, right?
Yeah.
And one heavily influenced by both regulatory signals and broader market sentiment.
Indeed, it was a mixed day for crypto, showing their inherent volatility. Bitcoin edged up just a tiny bit, 0.06%, to approximately US $115,380. Still holding strong, though.
Yeah, while it remains slightly below its August high, it's still up 3.43% over 5 days and a notable 23.45% year-to-date. Ethereum, on the other hand, dropped 1.74% to around US $4,520.
A dip there.
But still up nearly 5% over the past week and an impressive 34.91% year-to-date. So still strong performance overall this year.
And the regulatory side, still a big focus.
Oh, absolutely. Beyond price movements, the regulatory watch continues to be a major theme. The SEC is still reviewing several spot Bitcoin ETF applications.
The eternal question.
Right. Their approval could open crypto to a huge wave of institutional investment. And Europe's MiCA rules, that's the Markets and Crypto Assets Regulation, the big framework for crypto assets, are set to take effect in early 2026. That will profoundly shape the landscape in the EU.
Big changes coming then.
Definitely critical developments for the long-term maturation and, mainstream adoption of cryptocurrencies. So, still plenty of action and anticipation in the crypto world, with regulators playing an ever larger role. Okay, finally, let's bring it home. Focus on real estate and what's coming next for investors and homeowners.
For real estate, there was some genuinely positive news on borrowing costs. That directly impacts homeowners and potential buyers. Freddie Mac's survey showed the average 30-year fixed U.S. mortgage rate fell 15 basis points, down to 6.35% for the week ending September 11th.
That's the lowest since May.
That's right. Its lowest point since May. And it's significant because it could spark a modest pickup in refinancing activity, allow some homeowners to reduce their monthly payments.
Some relief, maybe?
A little bit. Yeah, this week is indeed a potential powder keg of central bank decisions and market mechanics. Today, September 16th, the U.S. FOMC meeting begins, sets the stage.
The main event.
Then tomorrow, September 17th, we get the FOMC rate decision itself and Chair Powell's press conference. That'll provide crucial forward guidance. Also on the 17th, we'll see Eurozone final CPI data. Gives us insight into European inflation.
Okay.
Then September 18th, it's the Bank of England's monetary policy meeting and the start of the Bank of Japan meeting. So basically all major central banks are in play this week.
Busy week for central bankers.
And then Friday, September 19th is quadruple witching.
Quad witching. Explain that quickly for listeners.
Sure. It's the simultaneous expiry of stock options, index options, stock futures, and index futures. Plus, you often get S&P 500 and NASDAQ quarterly rebalancing around the same time. This confluence of expiries and rebalancing is known to bring increased short-term short-term volatility. So expect some potentially choppy trading on Friday.
That sounds like a recipe for a very active and potentially volatile week indeed. What about the broader overarching themes and risks that all these individual events are feeding into?
Absolutely. The top themes we're tracking are, well, deeply interconnected. Firstly, there's the Fed policy pivot. How aggressive or how cautious will their easing actually be?
The big question.
Right. This directly influences the battle between global disinflation and potential energy shocks, which, could reignite inflationary pressures. We also need to keep a close eye on China's growth risks, particularly that persistent weakness in its property market. It has global ramifications.
Still watching China closely.
Always. Geopolitical tensions, exacerbated by those attacks on Russian energy infrastructure, continue to add a layer of uncertainty. And finally, there's a growing concern about potential credit market complacency, those tight high-yield spreads we discussed.
Yeah.
They suggest investors might be underpricing downside risks. That's something to watch closely.
So what does this all mean for you listening in? Well, yesterday's movements really showed just how swiftly global events and central bank signals translate into market shifts. From tech giants pushing record highs on Wall Street, reflecting that investor confidence in a Fed rate cut.
Yeah, big moves there.
To gold setting new records as maybe a hedge against the very uncertainties these shifts can create.
A complex picture.
It's an intricate dance, isn't it, between central bank policy, geopolitical developments, and corporate performance that shapes the value of assets worldwide.
Yeah.
And remember, if you're looking for intelligence that doesn't just keep up, but keeps you ahead, NextSight delivers. They support executives, analysts, and investigators worldwide with insights that are not only reliable, but immediately actionable. Check them out at nextsight.com. That wraps up the Monday, September 15th, 2025 Intelligence Brief delivered to you on this Tuesday, September 16th edition of The Deep Dive. Don't forget to subscribe on YouTube and Spotify and drop us a like, share, or comment. We'd really love to hear your perspective. So here's a thought to leave you with. As central banks deliberate, geopolitical tensions simmer, and market forces shift, how will these interwoven dynamics shape the path of your investments and your personal financial journey in the coming weeks? It's a question that connects every data point we've discussed directly to, well, your bottom line. May your Tuesday be more stable than repo rates after a tax deadline.
Let's hope so.
See you next time.